let's talk about interest rates. I think the level of interest rates is a top concern for many fixed income investors. Our colleague Joachim Fels has talked about the concept of the new neutral 2.0, or a period of extended, very low rates. So how is the IC thinking about this interest rate environment? And in particular, what are the return prospects for fixed income, and what is the role of fixed income in an investor's portfolio right now?
Sure. So, we do believe that at least over the short to intermediate term, inflation will be held in check, and interest rates, although they're quite low, will remain relatively range-bound. From that perspective, we're not concerned about a massive or significant sell-off in rates anytime soon. With that said, during this period of economic weakness, as we talked about earlier, we've seen significant policy accommodation. And that's going to manifest itself in significant deficits for many, many years to come. So I'd categorize our short-term views on interest rates as being somewhat neutral, respectful of what could be a volatile environment, but over the long run, a bit more caution. Now, in terms of the question around fixed income, what role it could play in a portfolio, I think it's important to first note that although the highest quality areas of global bond markets are at very, very low yields or even negative yields, we've seen massive volatility over the course of the last several weeks that have created very attractive opportunities across the broad global fixed income opportunity set. That's true of both public markets as well as private markets, where despite the fact that government bond yields may have declined, yields in other even high quality segments of the market have moved in the opposite direction. So again, with a more flexible approach, being able to target areas of dislocation or areas where we expect to see a bumpy path towards some stabilization, not only are there attractive yields, but there's also attractive total return potential as well. Whereas spreads tighten, you can supplement an attractive current income with significant total return potential also. So relative to the last few years, the opportunity set looks pretty darn attractive for a patient, defensive-minded manager looking to benefit from what we think will be, at some point later this year or even into next year, a stabilization process that could lead to some pretty attractive returns.